Hello. I hope this message finds you and your family well as we rapidly approach the holiday season and a new year. As you'll notice as we get going in this video, this is my first ever attempt to do a recorded video. So thank you for your patience on that. Um, actually, we actually take pride at Sage in professionally delivering a personal touch as often as possible. And although this message I'm delivering today is one I would normally prefer to do in person, I'm hoping this video message is something that gets us much closer to that personal touch. At Sage Advisors, we have several principles that are at our core. Clearly at the top is providing outstanding financial planning and investment advisory services. Another corollary with that is we want to do those at very competitive advisory fees. This last couple of years, we actually feel like we made huge strides in improving the services we do provide. It was just a year and a half ago, we went independent, becoming an independent advisory services firm. It was at the same time we changed custodians, moving all our client accounts to Fidelity, which was a meaningful improvement. Actually, for just over a year now, we've had a full-time CFA or chartered financial analyst on staff, directing our research and portfolio construction. A couple improvements we've made that are actually going to be much more close to home for you are things we've done with tax planning as well as strategic rebalance work. This last March, obviously with the volatility, we had some opportunities to do tax loss harvesting. What that means is we made some changes that actually will save our clients meaningfully in their capital gains taxes. Actually, I think we figured out in aggregate for all of our clients, we saved over $5 million in capital gains taxes. And with the volatility, that presented opportunity this last year for strategic rebalance work. In March and June, in particular, we did some strategic rebalancing that we back tested and realized saved that or improved at least by 1%, often at least 1.5%, the rate of returns our portfolios got above of what they would have otherwise received had we not done that work. And these are things that we can do now because of the commitment we've made to improve technology, which yes, leads to the point of this message. We've known for years that we meaningfully undercharge for the services we provide. And actually for years we could get away with that. But now that we've made the commitment to this improved technology and the things that we're delivering, it's come with a much higher cost of doing business. And we've got to the point where we really do need to make a modest increase in our advisory fee schedule. If you'd allow me though, I'd like to show you a few charts to put in perspective both our existing and what will be our new advisory fee schedule. Start here. This is the industry average advisory fee schedule. You'll see it's 1%, and it's 1% on the first $1 million of assets they manage. You can see down here the first 250, the first 500,000, 750, and first million. And it's at 1 million that most investment advisors begin to discount their advisory fees. We actually did further research to find out what the higher end advisory firms were charging and what the low, more cost efficient advisory firms were charging. This chart here is the higher end advisors. You can see they actually start at 1.5% on the assets under management and start discounting right away. And what I'm showing here is actually the lower 20% of all advisors. They still charge 1% on the first $500,000 and start to discount. This chart, actually, I'll be honest, when I first saw it, it surprised me quite a bit, is our current fee schedule. You can see not only are we below the industry average, we're meaningfully below the bottom 20%. And so we still want to be as competitive as possible. But this last chart, we've added this green line. This green line is our new advisory fee schedule. And as you can see, certainly for clients with more than $500,000 of assets, we continue to be extremely competitive, just not as competitive as we were before. As we've prepared for this change over the last few months, I've had the opportunity to share this with more than a few clients with whom I already had meetings scheduled. And I was very thankful. I've been very encouraged with their enthusiasm and their support. This new advisory schedule will require some new paperwork. Fortunately, it can be done digitally. So in the upcoming days, we're going to begin emailing to you DocuSign paperwork for this new advisory agreement. Even though this new paperwork will be coming in the upcoming days and weeks, this change won't go effect into the new year. Now, I know that there's several of you that are going to very much want to discuss this with me, and I encourage that. Please let me know when we can visit, and we'll have a good discussion. And I know there's going to be several of you that actually have some very simple questions, and don't hesitate to either call us or reach out to us via email so we can address any questions that you have. And for those of you that actually just sign and return it, I thank you in advance. Let me say thank you to finish this. Some of you guys I've worked now with for over 30 years, and I truly value you, and we value your business, and we look forward to continue to serve you for many, many years to come. If I don't get the opportunity to visit with any of you, or with you in particular in the upcoming weeks, I want to say, I want to wish you a wonderful holiday season and a great start to the new year. Have a great rest of your week.